We've got Ajay Bagga with us. Ajay, good afternoon. Let's get in a take as to how you're looking at the entire IT space first up, given the fact that we have seen that outperformance sort of continuing into this month. What do you expect the rest half of the year is likely to, or the remainder of the year rather, is likely to bring for the IT space?
Yeah, IT is looking good. There is continued buying in IT that we are seeing, and we expect better results coming in from IT. The AI part, which was, the cause for worry, and we have seen the employee headcount going down as well. What we are seeing is a number of end users coming in. So as I had explained earlier, the semiconductor companies, as the enablers were doing very well, as the suppliers of the AI chain were doing very well, and the end user companies were looking at end use cases, and in the center were our IT companies. Now we are seeing, if you see this quarter's management commentaries, 200, 300 caselets, 200 end use being talked about. I think that's coming through quite well. And IT remains a top sector, is what I would say.
Just today we spoke with Chintan Thakkar as well from InfoEdge to try and understand whether or not IT is in for a meaningful recovery or not.
If you look at last 6 months' time, and even if I look at the 4 quarters before that, it looks like that it's a kind of a U-curve type of recovery. So we have kind of gone a little bit down, particularly on the IT hiring side. We have for a few quarters remained flattish, and there are some green shoots now on the IT side. Non-IT in any case seems to be growing. So that's a positive outlook. So we are hoping that it's a U-shaped recovery, and we have tried from here it will go upwards. So hopefully this should result in the months to come, and there will be some pressure hiring as well because the utilization rates have peaked, and people and the IT services company really do not have benches available to them. So maybe that would be a positive news for the pressures.
Okay, fair enough. That's the view coming in on the entire IT basket. Meantime, Naresh, let's get in some chart checks going. Johnson Controls, 10% higher, and there's also a Bombay Burma that's active in trade.
So Johnson Control has been in a uptrend. It gapped up from the 1250 mark, went up to 2200 real fast, and did a little bit of a correction. Now again, 2200, 2250 would be a stiff resistance for the near term. So for now, given the spike of more than 10% in a day, would wait for a fade off going forward, but the trend is still positive. Bombay Burma, one needs to be looking at a profit booking zone going forward. It remains a holding company. The stock has gone from 1500, 1600 in June all the way to now 2600. So overall, if somebody continues to own a stop loss at 2500 would be fine, but at current levels, a fresh buy does not warrant a risk reward.
Okay, fair enough. That's the view coming in on some of those smaller stocks. In the meantime, how do you stand, Ajay, when it comes to the entire defense space? We were talking about a big shot in the arm having come in for the sector. A lot of these stocks as well are a buzz in trade, largely on the back of that nod for the aero engine deal. Where within defense do you find comfort?
Yeah, Avan, the issue in defense, if you recall, 3 months leading into the budget, we saw very sharp run-ups, and we were saying that the valuations are now factoring in multiple years of execution, and we saw a brief sell-off. I still think that defense holds a lot of potential. Valuation was the big issue. So now news flow driven moves we are seeing, as with this 26,000 crore order for aero engines and stuff. So a lot of it is now dependent on the order books or the new orders coming in. What is a given is very well run companies, mostly in the government sector. It is a sector which will continue to see a lot of investments as the defense gets modernized, and given the kind of challenges India faces with China and Pakistan on the borders. So the order books will continue to shine. Companies are very well run. They have good margins. What was an issue was the valuations. Are we out of the woods there? I don't think so. But you will get moves like this. We saw, I think three sectoral funds also being launched on the defense side. All gave negative returns over the last 2 months as the kind of correction that we saw. We are not out of that valuation, overvaluation zone. I would still say we can hold on and no fresh investments, either in defense or railways. Both were sectors which really got bid up going into the budget. We can wait some more time. Most of the good news is factored in. So you will see these kind of moves on the shipbuilders or on the defense contractors, but the valuations remain quite high, and the scope is more for corrections rather than going up further in the near term. I would say next 3 months, 6 months can be a wait and watch period for these stocks.
All right, wait and watch. And in fact, speaking of these stocks all rallying in trade, that's largely on the back of that anticipated outcome from the DAC meeting that's underway. Let's find out what exactly is on the agenda and the projects that are likely to receive a clearance. Our sources are picking up all of those details. Let's take it across to Prakash Priyadarshi to understand more. Prakash?
Yes, we are learning from our sources that the Defence Acquisition Council is likely to take some big decision today. The meeting is being chaired by the Defence Minister, which is underway, and we are given to understand that the defence projects worth rupees 1.4 lakh crore are likely to be cleared by DAC. If you look at the details of the agenda, sources are informing that DAC may clear acquisition of 26 Rafale maritime strike aircraft that will enhance the capabilities of Indian defence forces. Along with that, the decision likely on construction of 7 new warships with the cost of rupees 70,000 crore, which is part of the agenda, and companies like MGL, GR, SAR, prime contenders for building advanced warships. In addition to that, we are also given to understand that the DSC may approve the Indian Army's project to induct 1,700 new tanks that will replace Russian origin 272 battle tanks with the cost of rupees 50,000 crore. So these are the important agenda for DAC. For its consideration, we are expecting some big decision today.
Okay, some big decisions anticipated today. But Ajay, in the meantime, just wanted to understand your own sense on where is it that you see banks headed now? There's been that stark underperformance vis-a-vis the rest of the market. Credit growth clearly seems to be flagged off by one and all. Do you think banks can really play catch up, or do you think the underperformance and the gap within the rest of the market is going to remain?
Spot on. Banking has been an underperformer on a relative basis, and you have other options, and especially, I would say, Aisha, the bigger trend for the rest of the year is the rural economy coming back. The two-wheeler numbers have shown an uptake. That's a good pointer. Tractors are flattish to positive. I think the rural economy coming back is a bigger story. Banks, the issue is twofold. One is there is going to be a NIM compression given that there is a deposit war out there, and that sustainable funding is still being sought. There is no tax concession that the bankers were really looking at. And if you look at the amount of money that's going into the stock market, so from the affluent and the mass affluent classes, a big chunk of the financial savings are going into the markets through various instruments, be it mutual fund, insurance, the provident funds, NPS, or direct investments. And we are seeing bank deposits hurting. They have to increase rates, and that is causing a NIM compression. Second, in terms of where we are in the cycle, normally with the rate cut, again you see a compression of margins for banks, and that then is not a good forward-looking indicator for the performance of banks for the next 6 months. We are expecting rate cuts to start in India by December. And going into that, you could see continued underperformance from the banking sector. Other financials like insurance or mutual funds, even the brokerages have different drivers. That's a financialization driver. For banks, it's more disintermediation that's happening. Money is going into other avenues rather than sticking to bank deposits, and that's causing a margin compression along with the overall credit being being overall credit slowing down. That is contributing to weaker bank numbers, and that's the perspective for the next 6 months. But on a long-term basis, of course, they are the suppliers to a growing economy. They will do well. But I think next 6 months you can find much better returns in, say, power financiers or insurance or mutual fund companies. Those will probably do much better than pure banking plays.
Okay. Meantime, wanted to get in your take, Ajay, as to what the reading has been on some of these recent listings. Has anything, particularly stood out? We also had a very recent Ola Electric IPO. How have you looked at some of these stocks?
Yeah, it's a function, one of a good amount of liquidity really chasing, returns, and especially on the SME segment types, we have seen a huge amount of liquidity, really leading to massive listing gains and fundamentals becoming upended. So I think we are more towards probably the third. Uh, Part of the market, the third quadrant, it is we have gone past the mid cycle and probably going towards the late cycle, seeing the kind of valuations and the kind of frenzy there is to invest in new listings. When you have most of these companies have comparable peers available in the secondary market, but it's the listing gain. And because of the ASPA, what is your minimum return is your savings account return, and your maximum is your listing gain. And yesterday's SEBI report has shown the same, where 50% plus investors are jettisoning their listings within a week, and say 70% within a very short period of time. So it's more a gamification of investment that's happening through IPOs. In terms of companies, new age companies are welcome. They broaden the market. That is true. But the failure rates are also there in them. The good news is that most of those who make it to the IPO will hopefully create sustained value for investors. The issue only is that the smart money is getting out. So, more than 1 lakh crore of PE money has gone out, more than 1 lakh crore of promoter selling has already happened. Those two are not very good indicators for the markets. They are actually contrary indicators. You can say, okay, the funds might have matured, or you have to see it as pots of money and not as full pool in terms of the private equity part. However, that might be. There are cases where a new fund within the same family takes over an investment. When they are selling out and booking out profits, and the retailers are coming in and picking up that paper, it's not a very good predictor of future market returns. So I would say that's a word of caution with promoter selling and the institutional investors selling out through these IPOs. But a lot of froth, a lot of overvaluation, and a lot of FOMO are driving retail money into these IPOs, which normally doesn't end very well. Very difficult to say where you are in the cycle, but probably now we are at least in the second half, if not in the third part of the quadrant.
Okay, fair enough. That's the view coming in on some of those recent IPOs. And Ajay, what's the take when it comes to cement? So much consolidation that we've seen take place within the sector. A lot of the larger players galvanizing the smaller ones. What does this spell out for some of the smaller cement counters?
Yeah, attractive takeover options, and the market is punting on that. But overall, if you look at it, too much capacity already in and being brought on, again brought in. Yes, we have a massive infrastructure creation going out in the country. Second, rural demand picking up is a very good predictor. Normally, cement offtake is huge even in the rural sector. So be it the Pradhan Mantri Awas Yojana or the Gram Sadak Yojana or even rural housing, rural private housing coming up. Those are good predictors of cement normally. The issue is twofold. One is the overall volume growth is not that great. Second, too much of capacity has come in too fast, and still more plants are being talked about. Too much expansion of capacity has happened. That has taken away the pricing power just when raw material costs have been going up. So unless there is some rejig in the model, and hopefully, we get to a situation of an oligopoly where a few big players control the supply, which is what is happening with the smaller players being taken over. That will lead to some amount of pricing coming back. I remember 30 years back, or say 35 years back, uh, my professor was doing a thesis, and I had done, work with him on cartelization in the cement sector. So, it's not something new. It used to happen, but now the pricing paradigm broke up because of the massive amount of, capacities that came in. But now a few big players are gobbling up share. So I think it will become a 3 to 4 way market, and that will bring back pricing again, but not in a rush. Overall, good, very steady eddy kind of a sector, but not the right point to invest. I think you will have better options in other manufacturing names, or financiers of that manufacturing might be better off than cement players per se.
Talking about cement, JK Cement came out with their, Investor Day presentation. Let me take it across to Ashesha and understand the key takeaways from there.
Well, yes, JK Cement has laid out aggressive expansion plans over the next couple of years. As far as their clinker capacity is concerned, it currently stands at 14.5 MTPA, and they are looking to expand it by another 3.3 MTPA by FY26. As far as grey cement capacity is concerned, their current capacity, which currently stands at about 24.3 MTPA, and they are looking to expand it to 30 MTPA by FY26. In fact, they also say that beyond FY26, they have adequate limestone reserves and land bank in order to expand their capacity beyond FY26, and they've given a plan of about 50 MTPA cement capacity by FY30, implying nearly 13% CAGR over the next 7 years. Moving on to their paints business, which currently generates revenue of about 150 odd crores, they are looking to inch it up to about 250 to 300 crores by FY25. And remember, most of these cement companies have aggressive cost saving plans as well, and JK Cement has also said that they are looking to achieve cost savings of about 150 to 200 rupees per MT over the coming years. So yes, aggressive capacity expansion plans, cost saving plans as well. Important commentary that is coming from the management.
All right, thanks very much for giving us that heads up. In the meantime, Nuresh, let's get in your take then as to what the outlook is on some of these cement counters in trade.
So out of these names, JK Cement is the one which is broken out today after almost consolidating for 6 months, 6 to 7 months. 4,600 was a resistance tested 4 or 5 times today. That's the stock which has broken out. Ultratech continues to be in a trending up longer term basis, but on the short term continues to be sideways. Out of all the names, one is JK Cement, which looks interesting, and maybe a Dalmia Bharat if it starts sustaining above the 1950 mark. That's made a triple bottom around 1700 and is trying to reverse. So I would go with the smaller names like Dalmia and JK.
Right. Aditya, any stock strategies that you may have? Any BTST trades that you're spotting?
Actually, there's very less momentum in the market right now. But as we were talking about JK Cement, even I like the patterns of JK Cement. So that could be one of the carry forward trades. One can buy this at 4560 and 40 should be the stop loss, and target should be 4670 to 4700. And one more counter which is showing traction and saw good movement in the last hour is PFC. That looks good at 563.35. This could be bought at current market price, and stop loss should be 542 and target should be 575.
And Naresh, let's get in yours.
So the two names would be a first would be a buy on SBI cards, a revised stop loss at 760, target price of 775. Second would be a buy on JK Cement, which has broken out, a stop loss now revised to 4620, target at 4700.
All right, there you have it. Those are some of those BTST trades coming in. Just checking in on what the market is up to. And it's lackluster at best. If anything, a little bit of traction being witnessed within the broader universe. But metals continue to remain a big drag. Ditto when it comes to the PSU basket. How have you looked at everything that has taken place, Ajay, when it comes to Z Entertainment? And what's the update on how investors should be approaching the stock? Is it with caution?
Aman, overall, I can't talk on a particular stock, but media as a sector is well positioned. The problem has been it's the size of the sector, so it remains small. So uh, I would say that overall, if you're seeing India as a huge consumption economy, the media and all the other plays along with it, be it the OTT, be it broadcasting, be it direct to home, all other related sectors which comprise the media sector are very attractive. The issue has been that though a big money has entered a few of the companies, but we have not seen that kind of scale yet coming in. Governance and scale. I think these are the two big things. If we get that right, we will see at least a few companies becoming global companies via Indian media. But I think we are some time away from that. Particular stock I would not like to comment on.
Just looking at some of the other stocks which are, moving up right now in trade. And, we've been talking about as to how there is an uptick on Hero MotoCorp. They're definitely looking at launching perhaps an EV three-wheeler. That is what the buzz is on the street. And then, of course, you've got a Nestle, Titan, some of these urban or premium consumption trends are getting back right now in the market. And, of course, pharma continues to remain a steady place. Sun Pharma, Cipla, Divi's, they're all holding out quite okay as we speak right now. Wanted to get your sense, Ajay, on what you're thinking about FMCG right now. And within FMCG, are you looking or recommending at increasing exposure to the rural plays as opposed to urban?
Yeah, spot on. I would say rural place. The last 1.5 years in FMCG was premiumization story. As the rural sluggishness was there, the rural demand is picking up. The cycle is turning more towards rural consumption, which is more mass market kind of stuff. So expect staples to do very well, the FMCG players to do very well. And Aisha, normally what we see is that the jewelry companies as well as the gold loan companies also tend to do well as the rural demand pickup comes in, which is a bit of counter intuitive stuff, especially on the gold loan companies. But they seem to have a very strong correlation with the rural demand. So two-wheelers, tractors, FMCG, even durables, I think are going to have a very good next 6 to 12 months on the back of a reviving rural demand, and that will pick up. Urban demand is more sluggish. We are seeing an issue with entry level jobs. You are seeing all colleges today. We had IIT Bombay putting out a number that 75% students got placed, and the lowest placement was at 4 lakhs per annum. That is a predictor that you are seeing, and other leading indicators are showing a weaker urban demand, but rural demand is picking up.
Okay, uptick in rural demand. Ajay, we'll let you go on that note.
If you like this video, then like, share and subscribe to ET Now.